Welcome back, traders. Today we're diving into the world of momentum indicators, essential tools for measuring the speed and strength of price movements in the market. Whether you're a seasoned pro or just starting out, understanding momentum is crucial for making informed trading decisions. Think about it like this. You wouldn't just jump into a car and floor it without knowing how fast you're going, right? The same goes for trading. Momentum indicators act like your speedometer, giving you valuable insights into the force behind price movements. They can help you identify trends, spot potential reversals, and ultimately, make more profitable trades. Over the next few minutes, I'm going to break down 7 popular momentum indicators that every trader should know. We'll discuss how they work, what signals to look for, and how to use them effectively in your own trading. So, buckle up, grab your notebooks, and let's get started. First up, we have the Relative Strength Index, or RSI for short. This bad boy is a momentum oscillator that lives on a scale of 0 to 100. Now don't let the fancy name intimidate you. The RSI is actually pretty straightforward. Think of it like a thermometer for the market. When the RSI is above 70, it typically indicates that the market is getting a little too hot, potentially overbought. Why? Well, just like you wouldn't want to buy a used Honda Civic for $50,000, you might want to think twice about buying an asset that's potentially overvalued. On the flip side, when the RSI dips below 30, it suggests the market might be oversold, like finding that same Civic for $500. It could be a steal. But remember, just like with any indicator, it's not foolproof. The RSI is best used in conjunction with other indicators and your own analysis. Now here's a pro tip. Look for divergences. That's when the price of an asset is making new highs, but the RSI is making lower highs. This could signal a potential trend reversal, and you know what that means? Opportunity. But before you go all in, remember that every trader has their own risk tolerance and trading style. What works for one person might not work for another. So, experiment with the RSI, see how it fits into your strategy, and always, always do your own research. Next, we have the stochastic oscillator, another powerful tool in your momentum arsenal. This indicator compares a security's closing price to its price range over a specific period, usually 14 periods. Like the RSI, it oscillates between 0 and 100. But instead of focusing on price momentum, it highlights momentum in overbought and oversold conditions. Think of it this way. The stochastic oscillator is like a momentum detective, sniffing out potential turning points in the market. When it climbs above 80, it suggests the market might be overbought, a classic sign of a potential pullback. Conversely, when it dips below 20, it hints at an oversold market, potentially presenting a buying opportunity for astute traders. But just like with any good detective story, there's more to it than meets the eye. The stochastic oscillator has 2 lines, %K and %D. The %K line, the fast line, represents the raw momentum, while the %D line, the slow line, is a moving average of %K, smoothing out the noise. Look for crossovers between these 2 lines for even stronger trading signals. Remember, no single indicator is perfect, and the stochastic oscillator is no exception. It's essential to use it in conjunction with other tools and your own analysis for a comprehensive view of the market. Now let's talk about the Commodity Channel Index, or CCI. This versatile indicator can be your secret weapon for spotting new trends and potential market extremes. Unlike the RSI and stochastic oscillator, the CCI doesn't have a fixed range, which can make it seem a bit intimidating at first. But trust me, it's worth understanding. Imagine the CCI as a surfer, riding the waves of the market. When the CCI surges above 100, it indicates that prices are significantly above their average, suggesting a strong uptrend is in play. It's like catching a massive wave. Conversely, when the CCI plummets below -100, it signals that prices are well below their average, potentially indicating a downtrend. It's like wiping out on a big wave, not fun. But the CCI isn't just about identifying trends, it can also help you spot potential overbought and oversold conditions. Readings above 200 often suggest an extremely overbought market, while readings below -200 might indicate an extremely oversold market. Now, here's the key. Use the CCI in conjunction with other momentum indicators and price action analysis for a more complete picture of the market. Don't rely on it solely. Remember, the more tools you have in your trading toolkit, the better equipped you'll be to navigate the markets. Let's shift gears and talk about the rate of change, or RI, a momentum oscillator that measures the percentage change in price over a specific period. Think of it like the speedometer on your car, giving you a clear picture of how fast the market is moving. The ROC is all about identifying the strength of a trend. A rising ROC indicates accelerating momentum, like stepping on the gas pedal. Conversely, a falling ROC suggests waning momentum, like easing off the gas. But here's where it gets interesting. Look for divergences between the ROC and price action. For example, if the price of an asset is making new highs, but the ROC is making lower highs, it could signal a potential trend reversal. It's like your car's speedometer showing a decreasing speed while you're still pushing the gas pedal. Something's not right. Remember, the ROC is just one piece of the puzzle. Use it in conjunction with other indicators and your own analysis for a comprehensive view of the market. Now let's dive into the world of Williams %R, a momentum indicator that lives between 0 and -100, providing valuable insights into overbought and oversold levels. Think of it as your personal market compass, guiding you towards potential reversal points. When the Williams %R dips below -80, it suggests the market might be oversold, like finding a hidden treasure chest at a discount. Conversely, when it surges above -20, it indicates the market might be overbought, like paying a premium price for something everyone wants. But here's the kicker. Look for divergences between the Williams %R and price action. This can often signal a potential trend reversal, giving you a heads up before the crowd catches on. Remember, no indicator is perfect, and the Williams %R is no exception. Use it in conjunction with other tools and your own analysis for a well-rounded view of the market. Next up, we have the momentum indicator, a straightforward yet powerful tool that measures the rate of change in a security's price. Think of it as your market pulse monitor, giving you a real-time reading of the market's heartbeat. This indicator helps you identify the strength of a trend and potential reversals. A rising momentum indicator suggests accelerating momentum, like a healthy heartbeat getting stronger. Conversely, a falling momentum indicator indicates waning momentum, like a heartbeat that's slowing down. But here's the key. Look for zero-line crossovers. When the momentum indicator crosses above the zero line, it signals a bullish move, like a surge of energy in the market. Conversely, when it crosses below the zero line, it suggests a bearish move, like the market taking a breather. Remember, the momentum indicator is most effective when used in conjunction with other indicators and price action analysis. By combining different tools and perspectives, you can gain a more comprehensive understanding of the market and make more informed trading decisions. Finally, let's explore the Chanday Momentum Oscillator, or CMO, a unique indicator that takes both up and down days into account when measuring momentum. Think of it as your market mood ring, giving you a balanced perspective on the market's emotional state. Like other oscillators, the CMO ranges between -100 and 100, with readings above 50 typically indicating bullish momentum and readings below -50 suggesting bearish momentum. But what sets the CMO apart is its ability to smooth out market noise, providing a clearer picture of the underlying momentum. Look for divergences between the CMO and price action, as these can often signal potential trend reversals. For example, if the price of an asset is making new highs, but the CMO is making lower highs, it could indicate a weakening uptrend. Remember, the CMO, like any other indicator, is not foolproof. It's crucial to use it in conjunction with other tools and your own analysis for a comprehensive view of the market. And there you have it, traders. These momentum indicators are powerful tools to help you gauge the strength and speed of price movements. Remember, these indicators are just tools, and like any tool, they're most effective when used correctly. Take the time to understand how they work, experiment with different settings, and see what works best for your trading style. Don't be afraid to combine multiple momentum indicators with other technical tools and your own analysis for a more comprehensive view of the market. The more information you have, the better equipped you'll be to make informed trading decisions. So, go out there, put these indicators into practice, and remember, the key to trading success lies in continuous learning, adapting, and evolving your strategies. Happy trading!